So the beauty about property investing is in its simplicity. We don't have to overcomplicate things. But when we want to dig in and do some deep analysis, we can hit a bit of a stumbling block. The reason for that is that residential real estate is a private asset. That means our homes, whether they're homes we live in or homes we invest in, are not listed on stock exchanges. We don't have to disclose. My neighbor doesn't have to disclose. There is some information that we can go and get when transactions happen, and that is really about all the information we get in terms of pricing. Another area we can look at is banks, particularly in Australia, because our big four banks are all listed companies. They have to disclose to the stock market, and our big four banks have a big chunk of their portfolios in residential real estate. They make a lot of residential real estate loans. And so what I like to do is I like to go through and have a look at the banking results, not necessarily for the profitability. Shareholders can look at that, and that's for them to assess. I like to have a look and see what's happening in the bank's mortgage businesses, where the trends are going, so that I can extrapolate that information and use it for myself as a real estate investor. So I want to share with you some recent insights that have come through Commonwealth Bank's most recent earnings report, and the picture that they're painting in terms of the health of Australian residential real estate. And as property investors, this is really, really important. So one of the big features over the past year or two has been obviously the increase in interest rates. We've had the steepest increase in rates percentage-wise for the past 45 years. And there's been a lot of talk about people not being able to cope with higher interest rates as they rolled off fixed term rates that were in the low 2% range. If we actually come in here and have a look at Commonwealth Bank and what they're experiencing, we can kind of see how their clients are managing to cope with that. So this chart here is really interesting because it goes to show where rates are expiring. So you can see here the amount of rates that are expiring from fixed to new higher variable rates. And as you can see, we've got 3 sets of 6 months that have already happened while the RBA has been increasing rates. And we can see that based on their numbers, there's been a 90% retention rate. That means that they've held 90% of their loans. The other 10% have either sold their properties or refinanced elsewhere. And this is where I'm most interested. I'm most interested in arrears. Arrears basically means loans that are falling behind. And there's 2 measures. There's 30-day arrears, 90-day arrears. 90 days more critical because that means someone hasn't been paying off their loan for the past 3 months. And that's usually the point at which the bank moves in to repossess the asset. So 30-day arrears show us the most recent trend. 90 days show us the critical trend. And as you can see, the 30-day arrears on the loans that have expired with Commonwealth Bank are about 0.92% of their portfolio, which is in line with the rest of the portfolio. So all the other loans that haven't expired, that were on variable loans, for example. The 90-day arrears, or the critical element, is again in line. So we're not really seeing people that have loans going from fixed to variable falling behind more than what anybody else is falling behind. It's basically in line. And that's really, really important, and that's quite positive. If we go through here, another really important number is buffers. So what this shows is that Commonwealth Bank estimate that about 33% of their borrowers are ahead by 2 or more years, right? 2 or more years worth of repayments ahead. If we go through and have a look and see how many people are ahead by more than a month, it's about 78%. And people that are ahead by more than 3 months, if you add these numbers up, gives you a bit of an estimate. We can kind of sit there and say about 55% or more than half of home loans are ahead by more than 3 months, despite all the increase in interest rates. Again, quite a good sign. We're not seeing a lot of people, banking up in these areas, and that's not necessarily translating into arrears either. Again, positive for real estate. Now, on arrears, arrears is kind of the trend that I look for. One of the things you have to be careful with these bank results is that you don't get lost in the information. So as a former banking analyst, I know how to navigate my way through. I know how to gloss over what they want to show you versus what I want to see. So in the presentation, they give us 90-day arrears, but I've been a little bit tricky, and I've actually skipped the presentation and gone into the actual meaty part of the presentation, which is the actual profit report. 156 pages. I found the slides that I want to see, and I'm going to zoom in for you. What we see here is the trend in 30-day arrears and trend in 90-day arrears. So in the presentation, they want to give us this 90-day arrears. I want to see what's happening now. And as I look through that, I'm still okay, because what I see is on home loans, 30-day arrears, which gives me a sign of what's about to come, at 0.92% of the portfolio. So 99.1% of the portfolio is not in arrears. People aren't behind. 0.9% of the total portfolio of Commonwealth Bank, people are behind on a 30-day arrears, right? Are about a month behind. So what does that actually mean? Well, I can see the trend here. We are still below mid-2001 levels. Arrears at 0.9%, 30-day arrears, are actually pretty good when you consider how fast interest rates have risen. And what this is all painting for me, and we'll put a bow on this conversation here, is that despite all the interest rate increases, despite all the talk, all the media, all the press coverage about people defaulting on their loans, this fixed rate cliff, the amount of people falling behind is still below the level they were falling behind in mid-2021. And to me, that shows that people are always going to pay off their home loans before everything else. They'll cut back on spending. They'll cut back on luxuries. I'm sure they're cutting back on a lot of other things first. But as long as people have jobs, as long as there's employment, money is going to continue flowing into home loans as a priority number one. And I'm not yet seeing a trend that suggests home loans or real estate is at risk. What I am seeing is, if you have a look at personal loans and credit cards, they are ticking up. So in this chart here, it's the green that are the personal loans, and it's the credit card balances, the orange. They are going higher, which means people are tapping into debt to pay for things, but they're not defaulting on their loans. That means that the amount of real estate coming on the market is still depressed. We're not seeing pressure selling. We're not seeing banks moving in and foreclosing on homes by the thousands. That could happen, but it's not happening. And because that's not happening, that's why the prices in the market have actually stabilized. They've started rising this year. And that's why a lot of banking economists are actually coming out and forecasting markets like Sydney now to rise. Despite all the interest rate increases, things are quite resilient. And if you're investing in residential real estate, these numbers are very important. These numbers could change. This arrears line could change in the next 6 months. We're going to watch that closely. But for now, there is no cause for alarm. And it goes to show that the Australian residential real estate market, once again, is proving very, very resilient.